Get a corporate conversation going now on our show. Shares of PNB Housing Finance are under pressure after the company reported an operationally weak quarter, with the net interest margins coming in at 3.49% and spreads at 2.12% at a 6-quarter low. The company's gross NPA ratios, though, have improved and come in at 1.7%, which is a 17-quarter low. But the street is a bit disappointed with the margin performance. We have with us Girish Kousgi, MD and CEO of PNB Housing Finance, to take a few questions with us. Mr. Kousgi, morning. This is Rima here. First, if you could provide the outlook on margins and spreads. We have the performance in Q3. What is Q4 FY25 going to shape up in terms of NIMs and spreads?
Okay, good morning. So if you look at in last 1 year, we had taken a conscious call. Of course, this was, I think, a couple of years back, that we are going to run down the corporate book, and we will start only when we feel fit to restart. So obviously, if you have to look at the margins, we will be able to maintain margin, NIM of about 3.5%. So the impact was largely due to corporate book degrowth, and also there was a one-off effect. So I think that is the reason why this quarter is soft. But however, we are trying to fix this, because now we have launched Affordable, which is now a little over a year's time, and we see good traction in that space. And we also plan to start emerging market, in coming financial year.
Mr. Kousgi, good morning. So what is the rise in the cost of funds? I mean, what has that translated into, the higher risk weights now for NBFCs? What exactly has that meant for you? And when you say you'll try and maintain the margin, can you give us some rough band to work with? Is 3.5 a good estimate to have for the next couple of quarters, or do you think you can, claw back to the near 4% levels?
I think 3.5, it will be around 3.5%. It won't be 4%, because that was an aberration even in the past. I had mentioned when the NIM was 3.8, 3.95, that it is not sustainable, because we are into monoline business. In terms of cost of funds, the cost of funds actually for us has come down, even though it is just marginal. Recently we got an upgrade from India Ratings from AA to AA+, and now we have sanction of 3,000 crores from NHB. We have taken the first tranche, so that would bring down the cost. So we are also expecting cost to slightly come down going, in future, maybe in next 2 to 3 quarters time. So one, cost would come down. We will change the mix, and we'll change the segment-wise mix and try to improve on the yield. And that is why we say that NIM would be in the range of 3.5%.
Fair enough. What's the size of your affordable housing segment now, and what are the new segments you're looking to finance, and what might that size grow to, the opportunity?
In fact, we're just starting now. Affordable, as I mentioned, we just started a year back, and now the book is about 1,100 plus crores. And we are starting emerging market. This is basically focus on tier 2 and tier 3, where we would try to build the book at a higher yield compared to prime. Today, if you look at our overall yield is about 10.29% x one-off. And on the affordable, now it is 11.5%. So from April onwards, on affordable, we will up the yield to 12.5%. And on prime, the yield will be about 9.7 to 9.8. And from emerging segment, which is going to be about 40 to 50 branches, which we're going to start from April, there the yields are going to be about 40 bips higher than the prime.
Okay, so then affordable is making sense for you, rising yields there. That's what you want to focus on. Overall, can you just sort of give us a sense on the growth of the AUM, how you will probably end FY24 and an outlook perhaps, if you can, for 25? Because the thing is that even in this quarter, the disbursements were much higher, I think around 20%. The AUM growth was 4%. So is that because of the rundown on the corporate side? And just what's
Absolutely.
the outlook on the... okay, and what is the outlook on AUM growth?
So I think two things here. One is, I think directionally, PNB Housing as a company, we are moving into higher yield segments. That is, we launched affordable. Now we'll be launching emerging markets. So we'll be present in 3 segments from April onwards. That is prime, emerging markets, and affordable. Affordable and emerging markets would give us, upside on the yield, and prime would help us to grow. If you look at last 4 years, 16 quarters, 3 quarters out of last 4 quarters have been the highest. And also in terms of book growth. In last 16 quarters, last 3 out of 4 quarters has been the highest in terms of book growth. If you look at on a YOY, we are at 13.2% book growth on retail. We had guided about 17%. Now that looks like we need to moderate. It will be around 15%. However, from coming year onwards, the growth is going to be 17% on retail. Now, corporate book, which used to be about 18,000 crores, now it has come down to about 2,000 crores. That we will run it down. And going forward, the whole story is going to be on retail, within retail, these three segments.
Got it. So just one more question on affordable housing. I know you've started it a year back. The size is about 1,100 crore rupees. But, you know, I remember a chat we had with Canfin Homes, and they indicated that they're actually shifting from affordable housing to higher ticket, homes in terms of, lending. So, tell us why affordable housing at this point of time when the demand is more towards higher priced homes?
See, for a housing finance company, as I mentioned, it is a monoline business. So we need to have multiple segments. The company which you mentioned, that would be, for us equivalent of emerging markets. So affordable is one space where the scale up would be difficult, once the book reaches a particular level, but we can gain traction in next 2 to 3 years time and grow the book faster. Once the book grows to, let's say, about 10-12,000 crores, beyond that growth would be a challenge because you will have high attrition given the fact that the book would be at a higher yield and there is BT out opportunity, right? So similarly, the emerging market also would give us some impetus on growth and yield. So we want to be available in all the three segments, then we would have covered the entire spectrum of mortgage industry, being in prime, emerging markets, and affordable. The only segment where we won't be is the super prime, which we want to, I think tactfully we took a call that we need to come out of that segment because there's a lot of pressure in terms of rundown and also BT outs and also in terms of pricing. And therefore, out of the 4 segments, we want to be in 3 segments. And that is where the strategy. So companies which are only into affordable, they may want to get into a bit of prime to show growth. And companies which are into prime, they may get into affordable to better their yields.
Mr. Kousgi, we'll leave the conversation here for now. Thank you very much for joining in. The union budget is now less than 1 week.